Hi, I didn't get a chance to introduce myself before. My name is Brian Cruz. I am a current Boost student, and I'm on the organizing committee for the conference. Our next panel is ETA Models Overview, sponsored by Search Fund Accelerator, and our panel moderator will be Raam Jani.
Thanks, Brian, and thanks everybody for coming here. Thanks to Booth. My name is Raam Jani. I'm a partner with McDermott, Will & Emery. We're a law firm. We do a lot of search fund transactions, other sort of entrepreneurship through acquisition transactions. We might quibble a little bit with Mark Hoffman's view that you shouldn't use a big firm for search fund and ETA transactions. You know, you do need the right big firm, but I think using a firm like McDermott, and this isn't an advertisement for that. I just thought it was a little bit comical that he said that. I do think that finding the right person, though, and the right personality, and having the right attorney is obviously an important part of what you do. But enough about that. So I will turn it over to each panelist here. We've got a great panel, by the way. So if you don't know these guys, you should. They are great panelists. I'll let them introduce themselves. Explain their role in the sort of entrepreneurship through acquisition spectrum or ecosystem, so you kind of understand their perspective as we talk today on this panel about sort of different models of entrepreneurship through acquisition. So, Michael, I'll turn it to you first.
Yeah, my name is Michael Miles. I am a partner in a group called the Operand Group based here in Chicago. Many of you may know us, many of you may not know us. I got into the search fund world the Operand Group is a fund, but the way I got there personally was as an individual investor. So I've been investing in the search fund community for about 7 years. My partner Carlos Ayos is here somewhere. Carlos and I started the Operand Group, and our firm is really as much of a social private equity fund as it is a business private equity fund. We just are passionate about many of you in this room taking a career path to become entrepreneurs. And Carlos and I are both operators. We've been through the entrepreneurial experience. We think there's a lot of goodness that comes from the entrepreneurial experience, and you know, we have a fund that's committed to that movement. And many of our LPs that are in the fund are also committed to that. So what we try to distinguish ourselves about is just bringing in really, really good operators into our team that can, you know, support our portfolio investments. And then just quick background on myself. I'm an entrepreneur. I started a company when I was 26 years old. I didn't do an acquisition. I did a startup and kind of went through that full life cycle, and over a 22-year period then decided to do a second career, which was investing in search funds.
Great. I'm Austin Hall. I'm conducting a self-funded search here in Chicago. My firm is Brick Street Partners. Previously worked in investment banking and private equity, worked at Goldman Sachs in New York for 2 years doing industrials M&A, and then worked at Madison Dearborn here in Chicago doing private equity investing. I grew up in a family-owned business. My family also had a wood business, a building products company in Indianapolis, $50 million top-line business that my dad and my grandfather operated for close to 40 years. So I've had kind of a desire to be an owner-operator of a business since I was a college-age kid. So I'm focused on slightly smaller deals, sort of $500,000 to $2.5 million of owner earnings, and really focused on businesses that are Illinois, Indiana, and Wisconsin-based. Graduated from HBS in 2016, and I've been searching for about 12 months.
Yep. I'm Keith Gross. I'm a director at Pacific Lake Partners. Pacific Lake was founded in 2009 by Jim Southern and Coley Andrews with the sort of sole purpose to support search fund entrepreneurs through the entire entrepreneurial journeys, right? From pre-search, fundraising, through searching, acquiring, operating, and exiting. We would fall into, I guess, in the theme of this panel, the traditional search fund bucket. I would frame that kind of in the broadest of strokes, though, right? We exist to back great people, first and foremost, who want to run great companies. And there's a lot of different forms and structures under which we can do that, all of which accomplish the same goal and get you guys in the driver's seat. I have been working at Pacific Lake for about 2.5 years. I have a background in private equity. I've worked with probably over 50 searchers at this point, a couple dozen operating companies, and I work closely with the boards of Arizona College, Falcon Transport, IS Logistica in Brazil, Chronos Software, which are search fund businesses across the United States and the world.
I'm Josh Dennis with NextGen Growth Partners, and we are structured as a traditional private equity fund, but really focus on entrepreneurship through acquisition. So we support what we call entrepreneurs in residence that are effectively searchers to help find and then acquire, but most importantly, grow companies after the transaction. We currently have 5 entrepreneurs in residence searching, and we closed our first transaction this past August. So that Gabe Barkley is the EIR and is now running that business. Quick background on myself, investment banking and private equity investing, and graduated from Booth in 2016.
All right, my name's Tim Bovard. I'm the founder and CEO of search fund Accelerator, along with my co-founder, Jeremy Silverman. So we started this over 2.5 years ago with the first cohort of 4 searchers. The idea being really not to recruit searchers, but to find people who would be great CEOs of companies and help them get through the search phase to find and successfully acquire really good companies, because the quality of the company is key, not the time in which you find it. We have a fund of capital, committed capital that we raise each year, and that's available to fund the entire equity needs of each transaction. And then through working day in, day out with our searchers, we build a really fantastic and trusting bond with them that then spills over into the CEO phase, where we have a great relationship to help them grow the business. My background was essentially doing 20 acquisitions in Europe, building up Europe's largest book printing company over 12 years, and then along the way teaching entrepreneurship through acquisition at INSEAD and more recently at Columbia Business School.
Great. Well, this is, like I said, this is really a who's who panel of people in the entrepreneurship through acquisition realm, and so you guys are, I think everybody here is fortunate to be able to hear hear what these guys have to offer and some of the differences and distinctions. So, when we think about entrepreneurship through acquisition, there's not a right way or a wrong way, but there are multiple ways to make an acquisition and then to become an entrepreneur following that acquisition. And on the stage, we have represented the traditional search fund model. We have the unfunded search fund model or unfunded search model, and then we have an incubator or accelerator model, and all represented by these folks as they indicated. Another couple of models that I wanted to highlight, which again we don't have room for, like the whole stage would be full, and it's pretty full anyway. Another model is you go as an entrepreneur in residence or an executive in residence within a private equity fund. So we've seen that. We've seen entrepreneur in residence through family offices who are interested in getting into direct investing. We've seen that as another model, and then independent sponsor model, where the independent sponsor actually takes an active chair type of role, is also sort of on this spectrum. And again, it's a spectrum and it's somewhat fluid, so you don't necessarily, when you're starting out, you don't have to say, I am a traditional searcher or I am going to do unfunded. You can, and I've seen many times where somebody comes in, thinks they're going to do one thing, and then they sort of morph into doing something else along the way. So, but with that, I think there's a little bit of a baseline level of kind of what is that, or what is he talking about, what does that mean, that I wanted to start with here. And so, I think maybe it's easiest to start with the traditional model and sort of explain what's the traditional search fund model, and then we can kind of dovetail off of that. So Keith, do you want to kind of take the first one?
Yeah, so at its base, the traditional search model has 4 steps. Step 1, raise a search fund from a diversified set of investors. Step 2, use that fund to go find and acquire a good business with the mentorship of those investors. Step 3, run the company for 5, 7, 10 years under the guidance of a thoughtful board. And step 4, exit well. That's kind of the whole soup to nuts of the traditional search model. Under this model, I think you can find businesses with enterprise values generally between $5 at the low end, $5 million at the low end, to over $50 million at the high end. Your investor group would probably have some high net worth individuals who are former operators or just wealthy individuals who will write sizable checks for them at the time of the acquisition. And your group probably has some firms like Pacific Lake who can write larger checks at the time of acquisition. From at the low end, we write $500,000 checks, to at the high end, over $10 million checks. And that's just our share. I think it's important to note that the traditional search is not a control investor model. There's never, well, there can be a control shareholder, but generally not. Pacific Lake is not a control shareholder. I know Operand is not a control shareholder. So that's kind of at its baseline what it is. In terms of how your investors mentor you, it's really a demand-driven model, right? It's your rodeo, and if you want assistance, help, and mentorship, reach out to your investors, and they'll be happy to provide you with that guidance, with that assistance. I personally spend the majority of my days on the phone working with searchers and operators alike, just to be a thought partner in the room with them.
That's great. And Michael?
Yeah, I would just maybe emphasize and or add to a couple points that Kevin brought on. One is the kind of the power in the traditional search model is this, I call it kind of the power of collective wisdom, where you have a group of 10 to 15 investors and you get to leverage those relationships. And many of us that are part of those investors also have a network of people that we know. So now you have the network effect of your investors that you get to rely on as well. And I've seen that really become a huge asset for searchers that are choosing the traditional model, as they said, gosh, I have collective wisdom of a bunch of people. The other thing is just the power or the flexibility, if you're a searcher, of no one person having a majority stake, as we just pointed out, that you have a bunch of people that have a minority interest. And as a searcher, there's a different dynamic of that, particularly when you're in stage 3 and 4 of the business, when you're running the business. It's nice not to have any one person have a majority, because there might be a misalignment along the way there. And certainly when you go to exit, you want to make sure that you have flexibility in your exit strategy too, with a series of minority investors. So I think that's a big difference, as you're going to hear conversations of defining these 3 different models that we have represented is a diverse and investor base.
Yeah, and I think that's a great description, Keith and Michael, kind of the traditional model of doing a search fund. Timothy, maybe you want to talk a little bit about the SFA model and how you differ and how you guys do it, and then we'll go to Josh after that, because I think you guys have, some might view them as similar, but I think there's also quite a few differences and distinctions within their incubator accelerator model as well.
Okay, well, I will come back to talk about what Michael was speaking about. But when you look at the Stanford statistics and you see 27% of searchers failing, I found that fairly shocking, particularly being an educator. And there's such a steep learning curve in terms of learning how to search in such limited time that we feel that there's a lot of time wasted. And by creating an accelerator, we are constantly accumulating and refining the search techniques, because nobody wants to be a searcher. They want to be a CEO. So let's help them learn very quickly how to search, how to reach out, whether it's emails or letters or whatever, how you deal with due diligence, how you deal with negotiations, how you deal with a transaction, because you may only do one. So the first thing was to make sure that our searchers find and acquire really good businesses rather than being in that bucket of 27%. The second statistic that motivated us was that 35% of deals failed to return any more than just full equity post-acquisition. And so that means a searcher who's getting carried interest gets 0. And found that shocking. And while we talk about having the collective wisdom of multiple investors, if an investor has $50 million of net worth and has invested $300,000, I don't think there's a whole lot of incentive economically to invest themselves in that search. It's not going to move the needle for them. Whereas in our system, we have not only I would say the bond, the trusting bond by working with our CEO, future CEOs every day that motivates that, but also we have a fiduciary duty to the investors in our fund, and it's our full-time job. So I think there's a lot of advantage to having a control investor in the sense that it is a trusting relationship, a business partnership that is designed to last the duration, whether it's 5 years, 7 years, 12 years, or 15 years. And that will be the decision that will be made by the CEO, who retains the autonomy both during the search and as a CEO, but has dedicated, aligned incentive people alongside who have his back from day one till whenever they decide to exit.
Josh?
Yeah, so we're also trying to streamline the search process and put infrastructure, systems, IT in place so that when our EIRs start, they really try to hit the ground running. We also, at a firm level, develop relationships with intermediaries, attorneys like Raam McDermott's done a great job for us, and really try to accelerate the search process, but also surround them with a group of our advisory board. So it's 11 members. They're all very involved. Many of them are here right now, and provide the same type of mentorship that's been explained by pretty much everyone here, so that during the search process, mentor on communicating with business owners, getting to close, but then after the close, surrounding them at the formal board of directors level, but then informally with the relationships that are developed during that search process. We found that having the committed capital has gone a long way with a lot of potential sellers or intermediaries. But we also, in order to expand the network and get even more network effects, like Michael mentioned, encourage our EIRs to raise 10 to 20% of that search capital. So NGP is, call it 80 to 90% of that. So we like that for a few reasons, but it helps bring experienced advisors that are not necessarily in the NGP network yet to the family, and it also allows our EIRs to bring in personal friends, former bosses, or family, which we think can add a lot of good incentives for the whole process.
That's great. So those are, a couple of, we've got kind of the traditional model, we've got the incubated or accelerator sort of search model, and then, we don't really have anybody to talk about the unfunded searcher because there's nobody providing the funding, so we have to have an unfunded searcher himself on our panel. So Austin, I'll kind of turn it over to you.
Sure. Yeah, I would say my model is my model. The self-funded search fund model comes in a variety of shapes and sizes, but I think it's more akin to a traditional independent sponsor model where an individual is seeking to buy a business and will raise equity alongside the transaction due diligence process. So maybe I could just talk a little bit about why I decided to go down that path. I originally went into business school thinking I was going to pursue a traditional search. And the primary reason I decided to self-fund was that I'm very geographically constrained. When a person has a spouse who has a great job and wants to be in a specific geography, it's hard to move to any given city. So because I wanted to stay focused and living in the Chicagoland area, it made sense for me to self-fund. Most traditional searchers are pretty location flexible. So in the context of that, as I thought about and penciled out the budget, the amount of money I would need to search, I realized that it wouldn't be very much at all. So I have no travel costs. I don't have to have an office, although I do. So my burn rate is fairly minimal. I spend about $1,500 a month on my search, half of which is for an office space. And I knew that I would be able to fund that through my spouse, through savings, and through contract consulting work. So I figured out a way to fund the search. Thirdly, I think the self-funded model potentially works and lends itself a bit better to somebody who might have had prior investing experience, somebody who had been through a transaction, understood financing, capital structure, and how to conduct due diligence. Not to say that somebody who didn't have that experience couldn't self-fund, but I think more and more often you see self-funded searchers having worked in private equity or some type of investing, and I had done that. And then I felt pretty strongly that I wanted the compensation and economics that I would have in the transaction to be founded in the merits and the quality of that transaction. So when I have a deal in hand, when I have an LOI, and I'm going to potential investors to market that deal, I think for me it was important that the economics scale depending on how investors are interested or not interested in that transaction. So those are kind of the reasons that I decided to go down that path. I think at HBS in particular, there's a particular focus on people going down the self-funded path. I think last year there were something like 20 searchers coming out of that program. I would venture to say 90% of those people were self-funded. So I was certainly influenced by the nature of that program. But that just to provide some context for why I ended up choosing that model.
Great. So, I think the one thing that's really kind of an important distinction, and Michael and Timothy sort of started to hit on it a little bit, is how does the model balance, there's a mentorship component, there's certainly a capital component, there's an independence of the searcher component versus, you know, the sort of more independent, less independent maybe. And I guess as you think about it, you know, I mean, Keith, maybe we'll start with you. With the traditional model, how do you view that balance in the traditional model?
Yeah. Well, at its heart, this traditional search is a way for you to be your own boss, right? For you to lead and grow a company of scale. And that's the fun part of this, right? That's why you're doing it. It's not to search. But in the traditional model, being your own boss starts at the search phase, right? You pick your own investor group. You develop your search strategy. You pick your target industries. You decide how many interns you want. You decide how you want to approach sellers, with what pitch, how often, right? It's your show. That doesn't mean you're flying solo in the traditional search model, right? I think it's come up a few times. You have this group of mentors in the form of your investors and their extended networks who can provide a diverse set of perspectives, and importantly, as Michael alluded to earlier, a diverse capital base to help you get your deal done. And that means that if one investor doesn't necessarily like your deal, that's okay, because you have the rest of your investors who can help you get that deal across the finish line if they like it. So the capital's there, the independence is there. For us, it just comes down to, especially Pacific Lake, we want you to wake up every day from the moment you raise your search fund to the moment you exit your company 20 years from now. Wake up and know that you work for yourself. And that's really kind of the crux of the model that we aim for.
Timothy?
Working for yourself is great, and that's what all of our searchers do, because they're determining what kind of companies they're looking for and ultimately what company they're going to buy. But I think it's this whole thing of I have to learn by going through this long and arduous trial and error process is incredibly wasteful of time. I think it's much better to spend more time having a larger N of companies you're going to look at, and more quickly, by increasing the velocity of that search, hone in on much better companies, because that's how you make it in this model. You have to find a really good company where you can grow it and minimize any risks of failure. And the failure statistics just don't lie. In our situation, if a searcher can look in any industry they want, including manufacturing, because they're all very smart and can find that manufacturing company that's precision or specialized manufacturing. And they can look anywhere they want, because the marginal cost of testing it is walking 10 feet to talk to me or Jeremy, or going over and talking to the other 8 searchers that are currently at SFA, where the collaboration is a huge component of what we do. And so this mentorship, the training, the leg up of getting through the search, I think is just incredibly efficient. Then they can focus their time on closing that deal and then doing what they really want to do, which is being a CEO. And you know, as we heard, it's much better and easier to be the CEO of a great company rather than stepping in day one and having to suffer through a business where you didn't do good due diligence, or there are structural problems with the company that you didn't see, and then having a 5 to 7 year period of suffering. So you know, we're just trying to help all of our CEOs succeed.
Like quickly, we like to think of each EIR is the CEO of their own search. They're in separate LLCs, they're not W-2 employees, and they're constantly coming up with their own industry theses. I think the difference is the collaboration amongst the EIRs. I hear some concerns over competition, and we really haven't experienced that. It's more of challenging each other when somebody does have an idea and helping refine that, and using best practices that are learned as a group throughout the search process, and as NGP continues to grow, future EIRs learning from what these past EIRs have learned. So, you know, doing that requires a lot of trust going into the relationship. And so that's why we take a lot of time getting to know our EIRs before they join. It's not a relationship that is developed over, you know, 2 or 3 meetings. It's, in all cases, been multiple years of really getting to know the people, making sure that they trust us and that we trust them.
That's great. I mean, I think it's good, and again, I mean, this panel, the idea is to draw distinctions, and I don't think there's, like I sort of started this with, there's not a right and a wrong, but there are some differences. So shifting gears a little bit, and Austin, you started to touch on this, I think, with your last answer about kind of how you chose to go the unfunded route, and I think there was some practical side of it to you, but also just from like a personality and a professional ambition standpoint. I mean, is there something that's unique, and what kind of? I mean, I'll start with you, but turn it over to the other folks too. Something special and unique, or some reason why this appealed to you specifically?
I think to some degree there's a bit more of autonomy in a self-funded search, so I'm able to look at situations that don't fall squarely within the realm of what a traditional searcher might evaluate. For instance, I look at a lot of manufacturing companies, and that's sort of the nature of the economy of Illinois and Wisconsin. But that's something that I wanted to be able to look at. I would say, as I said, Raam, people who are trying to craft a search around their life, meaning you want to live in a certain place. I think the self-funded model is probably, one of the only options, and maybe you could correct me if I'm wrong, Keith, but I think that, it's difficult for searchers to raise search capital if they tell a search fund investor that, I want to live in a certain part of the country, or I want to live in a specific state. So I think the self-funded model maybe potentially lends itself to that kind of specific preference. I also wanted the flexibility to look at smaller transactions. As you look at sort of the pyramid of businesses across the economy, businesses that do $500,000 to $1 million of EBITDA, there are a lot of those. And I wanted the opportunity to look at those transactions and also know that the math was going to make sense for me and that the economics would actually potentially be worthwhile. And I also think, solving for what your own professional objectives and long-term objectives is really crucial. I heard in the last panel the idea of owning and operating a business for a long period of time. If I had it my way, I would raise capital from a group of investors. In 5 years, I would buy them out, and then I would own the business until the end of time or whenever it made sense to sell. So my objective is not to have a big liquidity event or an exit, but ultimately to try to own a cash flowing asset for a very long time. And I think the self-funded model potentially was more aligned with that objective.
That's great. Josh, what about, kind of same question to you on your model?
Yeah, I think I hit on a little bit, but really we're looking for good operators. And I think our model lends itself to maybe people with less investing experience, but more operational entrepreneurial experience, so that we can act as that partner to help get through the M&A process, through due diligence, helping evaluate deals in industries. So the types of people we're looking for I think are all fairly similar, but it comes down to getting to know the people at NGP and building that trust. So other than that, I think the traits Austin hit on are fairly similar.
All right, Michael, I'm going to give you the last word on this one. The traditional model, any distinctions or differences, or is it kind of similar?
Yeah, I think there's a lot, but I concur there's really no right or wrong answer. This is something that if you're deciding to do a search, you should probably really evaluate what your personal objectives are and which vehicle best aligns with that. And I would encourage you to think about all the things that you heard on this panel, with maybe the exception of one other point that we didn't touch upon, which is what happens if things go bad? And where are you what happens if you need to raise more equity? What's your investor base appetite towards doing that? Where do you have the most optionality? Where do you have the most flexibility? And that's true when you're putting your composition of investors together all the time. You want to look for, what's people's appetite towards doing that? Like, you wouldn't want to, I think, I don't know, just this intuitively makes sense to me. You wouldn't want to have a single source of capital who is in the 7th year of their fund, who's committed to their LPs that they have to return money back in 4 years, and they weren't raising another fund. I mean, that would be a bad scenario for you as the CEO. So I would just encourage you to look at not just the first bucket of money that you need. You may need another bucket, and what investor group gives you the most flexibility to do that. But there's a bunch of points that I could echo here, but
Yeah. No,
in efficiency of time, let's move on.
No, and I think that, I mean, most of the people who are in the room interested in doing one of the models, probably, 85% of the things that everybody's looking for are the same, and then it's, you have to find your own personality differences, your own, ambition differences, and not that one person is more ambitious, but one person may have an ambition in a certain direction where this is more important, or, an ambition in a different direction where a different side of the house is more important. And I'm cognizant that I want to make sure that we have time for questions, because I think this is, again, and maybe I'm saying like a broken record, but this is a great panel and a great group of people to ask questions of, and to challenge them a little bit. I didn't tell you guys that part. I want the audience questions to challenge these guys, not me, but challenge these guys. So I will, we will open that up. So make sure you're kind of thinking of your questions now. But maybe let's just talk about the current state of the model, current trends in the model, success rates, growth. I'm not sure how much data we have on all of the different models. Are there particular types of acquisitions, any investor trends? Like, let's kind of hit on some of those points and talk about, where we think things are headed. Keith, I'll go ahead and start with you on this one.
Yeah. So the most obvious trend in the space is that the search fund model is becoming way more popular. If this first search fund conference, not necessarily put on by Booth and Kellogg, but maybe going back 8 years, had about 25 people in the room. I've seen the photos. So the model's become more popular, which has attracted new investors and therefore new money. And it's allowed all of us up here to find really creative ways to continue to support all of you. I think one of the trends you'll see is continued creativity coming out of the search fund investor world to try to help you find something that fits for your needs and what you want to do going forward. In terms of, I think Raam, you said success rates, the Stanford study numbers, which Tim alluded to earlier, would say of those who try to raise a search fund, 80 to 90% of you will be successful. Of those who do that, about 75% will acquire a company. And of those who acquire, 2/3 to 75% will have a successful outcome, defined as more than 1 to 1.5 times investor capital. There's no reason to believe that those numbers will change over time, and I would caveat that those are the Stanford numbers and not necessarily the numbers anyone up here is experiencing. Lastly, you said types of businesses. The types of businesses haven't really changed coming out of sort of at least the traditional search fund world, right? They're primarily B2B service businesses, both in the US and internationally. They have a history of profits and growth. They're in growing industries. They have recurring revenue. They're coming from primarily proprietary sources. That's been pretty consistent over time. If there's one thing that is changing, we're seeing searchers be more comfortable looking at bigger acquisitions, and I would define that as maybe $2 to $6 million of EBITDA. Anecdotally, the last 4 Pacific Lake acquisitions have had over $4 million of run rate EBITDA and required between 10 and 25 million of total equity. So we are seeing bigger deals come into the space, which is great and it's exciting, and it gives the entrepreneur more flexibility to work once they're in there.
Timothy?
That's interesting because we focus on a very different segment of the market, because we kind of believe that from 1 to 2.5 million of EBITDA, you're looking at a much larger population of companies across the United States. So that's going to increase the odds of actually finding a company, and not just a company, but a good one. Also, and this is I think probably echoed by Royce Yudkov and Rick Ruback, you're looking for companies that are small for a good reason. They're small because the previous owner didn't have the ambition of growing it bigger. He was getting $1 million a year, and before that he'd been a boiler technician in a Navy vessel. So he didn't think about growing it bigger. Whereas somebody else can come in and see a market where he can grow it to 50 or 100 million. So these are companies that can be grown substantially, and yet because of the size you can buy them at multiples of 3.5 to 4.5 times, which if you do grow it into that space of beyond 5 million of EBITDA, you will logically get a significant multiple expansion. So I think there's some micro considerations that need to be taken into account when you're looking at a population of companies. Bigger is not necessarily better. I'd rather take something small personally and grow it to something very substantial.
Great. And what about some challenges also? I mean, so Austin, I don't know whether you have any, kind of like sort of hierarching challenges, nothing in the unfunded model in particular, but anything that you're seeing in the space, or, are there like too much competition, not enough competition? I mean, I think what Keith said is right. There's lots of people kind of in this, starting to play in this market now. I mean, I don't know. What do you see in Austin?
Probably less competition where I'm playing and where Tim's playing, just from a buyer perspective. I think my feeling is kind of once you get above $1.5 million of owner earnings, the buyer universe kind of starts to grow. In that $500,000 to $1.5 million range, I think the market's not even close to matured, which is why I think it's an interesting place to be playing. I think the challenges are probably pretty similar to most searchers. High valuations, a lot of owners who haven't committed to selling, having difficulty introducing a sense of urgency into proprietary processes has probably been my biggest challenge. Are we actually going to get on this horse or not? And developing pattern recognition around what owners say that would signal that they're a serious seller, I think I've gotten better at but have struggled with. Maybe just quickly, I just wanted to mention, I did mention this before, Raam, there are certain drawbacks behind the self-funded model that I should be very clear about. You're almost certainly going to have to sign a personal guarantee on the bank debt that you have to finance the deal. So one, you got to be comfortable putting all of your personal assets on the line, and not everybody's willing to do that. Two, it can be a very isolating experience if you don't do certain things to surround yourself with people who could be mentors and advisors and actually be a sounding board for you. Otherwise, it can feel like you're doing a lot of things in a vacuum. And I think the third thing, which is an important point, people will question your ability to finance a deal. So you've got to be very clear about where your capital's coming from, have a story around it, potentially have letters from potential investors, or be able to put owners or brokers in touch with those investors. But people will question your ability to close, and it's a reality because you're raising money alongside the deal. So I just thought, to present a balanced perspective, I'd share those. Yeah.
I think you also have access to SBA loans.
Yeah, and that's almost, sorry, I should have mentioned that, Tim. Most self-funded searchers will use an SBA 7A loan. You can finance up to $5 million of senior debt through the SBA. It's incredibly attractive financing. I would encourage you all to look it up on the SBA website, but it does come with a personal guarantee kicker.
Josh, any thoughts?
Yeah, I'd echo several of the challenges that Austin mentioned. One that comes to mind that we're constantly debating, evaluating, and testing is kind of a rifle versus shotgun approach, if you will. So spraying a huge volume of companies without much email customization or personal phone calls or handwritten letters, so less likely to get responses, or take the rifle approach and really do a lot of research on the company before sending anything, have a lot of customization, make it very clear that you know what you can about their business. And obviously the drawback on that is mostly the time commitment involved in each one. And then the second, I guess, to stick with a hunting and fishing type of motto is, how quickly to cut bait, or do you reel them in slowly? Austin talked about creating a sense of urgency in proprietary deal flows. It's a challenge because in most cases, in truly proprietary deals, they weren't necessarily looking to sell their business. They don't necessarily need to sell. So it's developing that rapport, building the relationship to convince the sellers that I'm the right person to sell to, and I'm the right person to sell to now. And because there's no real pressure on them to sell it, it's a big decision that takes a long time. So it's how much time do you invest in those types of conversations and interactions before actually cutting bait.
Yeah, those are my favorite clients, are the sellers they're very easy to work with, because when I represent them as a seller's lawyer, we can just basically say no to everything that the buyer wants in the legal documents. It's just no. So you end up with a pretty good deal if the seller doesn't want to sell. All right, Michael, I'm going to ask you to just pull out your crystal ball. Where is ETA headed generally? What do you think?
Well, it's exciting because it's getting bigger, and I think it's really driven by all of you in the room that are making this career shift, or many of you contemplating making a career shift, going to work for the man, like Mark said, or going to work for yourself. And I see that movement will just continue, and the ecosystem will grow in every single angle, from people like Raam's firm and accounting firms and insurance firms having practices that are centered around the search fund ecosystem, to investors bringing more money to the table, to a secondary market appearing in this ecosystem, to incubators and accelerators and new models that are emerging. I even think that the types of companies that we start buying will start to change over time as there's more searchers out there. We think about this with buying businesses from baby boomers. There have been many successful transactions of buying businesses from entrepreneurs that don't know how to scale the business and want to go on to the next one, but have built a decent infrastructure around a business that's acquirable. So a lot of good things, I think, and probably more B schools picking up programs around this, and B schools probably setting up funds to invest in their students will I think, be an emerging trend as well.
This is great. I mean, Brian, I know. I mean, how do you want to handle the Q&A here? Yeah. Okay. I mean, do you have? Okay. Are you? Yeah. If you find a question, sure.
My name is Bakari Pace, and Raam, my attorney. So go with Raam. He's a good guy. Austin, I feel a lot of kinship with you. I'm under LOI. I'm a self-funded searcher. I focus primarily geographically in New York, New Jersey, and Connecticut. I found multiples to be a little bit higher in that area relative to what I was expecting. I used to joke with people that I was only looking in Manhattan on the D line. If it was off the D line, I wouldn't look. But looking in that geography, it's been higher multiples. I just want to know, have you seen lower multiples in your geography, or has it just been standard, the 3 to 4?
There's a very clear distinction between a business that's valued if it's based in Chicago or if it's based in Rockford, Illinois. If you looked at my IOI sheet, you'd be able to see that pretty clearly. So, would I like to buy a business 30 miles from Chicago? Well, yeah, certainly, but I'm probably going to have to pay a turn higher on valuation. So I've been trying to spend time in places like Rockford and Madison and Milwaukee and Indianapolis, and places that are not, right in the heart of Chicago. Now, that makes it a little difficult to live in Chicago and run a business in Indianapolis, but major metros are very competitive, Chicago being one of them. So I've certainly seen the same, below $1 million of owner earnings, not as much, but for businesses that are above that, I don't often talk to businesses who aren't already or in discussions or have been pinged by other buyers.
Hi, I'm Ronald. I'm a current second-year Wharton student, and I will say that I'm very jealous of the community and resources you have here at Booth & Kellogg. So glad to be here and glad to ask you these questions. So I've talked to a lot of different past searchers. I've even talked to Tim and Keith up here. And in these conversations, how well do we really know each other before you make that initial investment as you embark on this process to find a company to acquire? So in my conversations, I've talked to some searchers who said, well, we thought we had an idea of what customer concentration was. Then we started showing deals to these firms and these investors, and they had a different idea of what customer concentration looked like. So, and that was a big gripe that I've heard from searchers who've acquired companies, right? If they could redo it again, what would be different? They would clarify some of these terms. So from your perspective, what are some of the common things that you start to realize there might be differences between the way you view something and a searcher views something, maybe due to searcher inexperience, or maybe something more philosophical? What are some of those things you really see?
I would say, sorry, go
I'll take
ahead,
a
Michael.
stab at this one. First of all, I think it's really important that as you're evaluating your investors to maybe ask those questions in the process of determining what investors you are going to be bringing on. That's the obvious way, is just make sure you're calibrated early on. And then as you're bringing up a deal, before you spend too much time on it, socialize it with your investor group and make sure that you're not going down too far of a path before you have characteristics of the business that aren't acceptable. I don't think any of the investors in the community have really hard and fast rules of like, won't do this, won't do that. Maybe there's a few that are, but the word never is pretty extreme, that will never do it. And again, if you have multiple investors, one group of investors might say no, and your other investors might be super bullish about it. But I hope I'm getting the answer to your question in there somewhere.
I was just going to say, at SFA, it's a constant dialogue. I mean, we're working right next to our searchers, and every company is a different situation. Everything can be interpreted differently, so it's a constant dialogue, and we're learning together from the first day they hang up the phone with the seller to the day they close, and it's just a journey we do together.
We have time for probably one more question.
Hi, my name is Richard Belushin. I'm a second-year MBA at Carnegie Mellon. I have actually it's going to be a three-parter. So one, have you seen a little bit more specialization in terms of people maybe who only want to be searchers, people who only want to be operators? The second part of that, how do they position themselves? And the last part, maybe speaking to Michael's point earlier, does that speak to the secondary market at all?
Can you repeat the first part of that question?
Yeah.
Sure thing. So the first part, have you seen any specialization at all in terms of people that maybe they want to go into this only being searchers, or they only want to go into this only being operators?
Have you run into someone who wants to dial the phone all day as a searcher?
I have not, but I've ran into guys who are more interested in doing deals.
Yeah. Yeah, I think we haven't seen much specialization where it's kind of breaking down between I want to only be a searcher. I think that's probably the more rare side versus I want to be an operator, right? I would say the majority really want to be operators, and searching is a means to an end. And so from that perspective, I guess we haven't seen someone have to position themselves as really wanting to search full-time and have a partner who wants to operate full-time. And I don't suspect, or at least from what we've seen, suspect that'll be a trend that takes hold anytime soon. But please, if anyone thinks differently.
You raise an interesting point. This is not about doing deals. This is not the alternative to the private equity job you didn't get. This is about one thing. It's about being a CEO. And I think regardless of the model or anything, if you can't say, yeah, I'm willing to move to Little Rock, Arkansas and run a company for the next 10 years, then it might not be right for you. Okay, if you have a geographical constraint, pick the worst place in that geography and say, would I live there? But that's what it is. It's a conviction to be a CEO and to run and grow a company. It's not about doing deals.
We have just one more question, then we'll go to lunch.
Appreciate the time that you guys are taking. So you've all been successful kind of your own volition. And maybe with the exception of Austin, you're operating in a different space here in ETA, right? So you're talking to a lot of people who I think want to go be operators, but you're seeking to be an investor in people who want to go do operations. Why do you find for yourselves, knowing that you could be successful, were you to go be an entrepreneur in another venue, why are you choosing to pursue investments versus operations?
For me
personally, I've already done it, and I wanted to be involved in the ecosystem of entrepreneurship and continue to work with people to help them become entrepreneurs. So I ran a company for 25 years, and I just got older in life and said I don't want to do this anymore, and I'd rather work with young people on board roles. So it's a lifestyle choice for me, not an economic choice.
For me, I
was just saying, Michael, we totally agree.
So I seriously considered going down that path out of business school. Interned at a search fund acquired company during the summer in between my 2 years. And that's how I started developing a relationship with Brian and several other members at NGP. And so as we were going through this process, the original context was to be an EIR. But I actually liked being on the investing side too. And building this firm really scratched that entrepreneurial itch. I do feel like an entrepreneur, even though it is an investing firm. So that's the balance for me and why I ended up choosing to be in this role.
For myself, working with entrepreneurs is exhilarating, right? Helping them grow, not only personally, but grow a business is really fun. I don't look at it as sort of, we're investors. I imagine everyone up here feels the same way. We're not investors like we're private equity investors. I would view us more as, like mentors to the people who we get to the opportunity to work with, and it's just really exciting for us to show up every day and work with people who are really excited to show up to work every day.
Yeah, and I would echo that from the legal side. I mean, this is part of working with cert funders for me is definitely an exciting part of my practice because of, like he said, I mean, these are young people who are doing exciting things, who are doing great things, and you know, maybe they'll do the next great thing too. But I think for now they're doing something that's great. They're kind of changing their own lives, but also helping grow businesses. Expand jobs, expand kind of life for companies that exist today that are in this smaller market, and maybe we'll grow bigger. But it's a great place to be as a lawyer working with these guys too.
Great. Please join me in thanking our panelists. So lunch is next. We have a little bit of a twist on it this year, as Timothy was explaining. We have lunch on 2 floors, 9 and 10, and certain members of our ETA community have been assigned to specific tables, kind of forcing people to break up and to meet new people, i.e. you. So take a look at the board. This is also in your, towards the back of your booklets. And 1 through 20 are on floor 9, and 21 through 30, plus some extra tables, are on floor 10. So we need to be back in this room by 1 o'clock. So with that, please enjoy your lunch.
When you nod your head yes.